Hi guys, so let's look at some of the key causes of demand pull and cost push inflation. Let's firstly start with demand pull inflation. Now remember, what is taking place here is aggregate demand is increasing at a rate above and beyond that of aggregate supply. Now as a direct consequence, there will be an increase in the price level, and we can see that represented by this shift in the aggregate demand curve here, corresponding with the P1 Y1 outcome level, an increase in the actual level of demand in the economy. The total demand increases, the aggregate demand shifts to the right, and we see that higher price level. So the price level has increased, okay, from P1 to P2. Economic output in this scenario, according to Keynesian economists, would actually pick up to start with, though, before we reach that point of inelasticity on the long run aggregate supply curve. Okay, now why might this occur? Well, if you think about reducing interest rates, this will have the impact of increasing consumption, possibly increasing investment, as well as borrowing costs are reduced and firms and households are no longer incentivized to actually save money, or certainly incentivized at a lower rate. So therefore, reducing interest rates can shift aggregate demand, certainly. Another key component of aggregate demand is, of course, that of government spending. So government spending, if that increases, it's going to increase aggregate demand. In addition to that, there could be a multiplier effect, and where there is a very large multiplier and a high marginal propensity to consume within the economy, again, you're likely to see a further increase in the actual price level as that multiplying effect kicks in. Okay, then we've got the point regarding higher wages. If you're getting higher wages, your disposable incomes may well be rising, and that may fuel demand for additional expenditure. So therefore consumption may well again increase as a direct result, and that will lead into further price rises further down the line. Final point here that I've put down is about increased money supply. Now, if you increase the money supply, the value of the money actually falls. Value of money falls as the supply is increased, much like any other good. And when the supply increases, the price will fall. Okay, so the key element to understand there really is that as the price actually falls, what is really taking place is inflation is taking hold. And that is because the value of the money is diminished. Okay, so that will therefore increase people's demand for money, because they need more money to actually conduct a given level of spending. So those same goods would now cost more, and so increasing the money supply would mean that you have to pay more for certain goods, and thereby increase people's demand for money and the actual amount of money they need to conduct any given expenditure. Okay, so when it comes to cost push, let's have a look at these factors. Firstly, depreciation of the currency. We've seen this since June 2016 and the Brexit referendum and depreciation of the pound, and we've therefore seen this scenario: weak pound, imports dear, exports cheap. So while it has been good news for some of our exporters who can now price themselves far more competitively in foreign markets, for our import industry, it's not been so great, okay? And the reason for that is because import prices, of course, have risen. Okay, so that feeds through to inflation, and that is the key reason, really, why inflation has been above target in recent months. Increases in VAT are also important here, okay? Because remember, when it comes to cost push, you're looking at the cost of inputs rising. So the cost of inputs suddenly rises, and therefore you've got to pay more for those inputs, which feeds through to higher price levels in the future. So an increase in value-added tax from say 20 to 25% would add an extra markup to all those goods and services that were actually purchased, and that would lead to a short-term increase in cost push inflation. Rising commodity prices, yes, so we're well aware of this. If oil prices go up, then it tends to feed through into the price of just about every other good, because every good needs to be distributed with the exception of those digital goods. So another interesting example. Higher wages, yes, well, higher wages of course means that while we've got it over here, we've also got it here. Higher wages means that businesses have higher costs, so their cost curves would actually rise and shift back to the left. Okay, then we've got inflation expectations. So if you anticipate further inflation further down the line, then again that can actually mean that firms begin to start putting up their prices in anticipation of perhaps oil price changes or perhaps other commodities changing, be it wheat for bread or so on. Okay, so let's just quickly have a look at the impact of this when it comes to cost push inflation. Here I've just opted for a classical model. It's important that you become quite fluent in being able to use both the Keynesian and the classical interpretation of, or monetarist interpretation of the aggregate demand, aggregate supply model. And here we would just put our short run aggregate supply curve 2, and there we've got short run aggregate supply curve 1. So what we can see has taken place is we now have in the short run reduced level of economic output according to this interpretation. We can see that quite clearly together with the price rise. Now in the longer term, classical economists, monetarists would believe that you reach that full employment equilibrium once again though. Okay, so we can see that quite nicely there, that there is certainly an increase in the price level, but then people would begin to adapt their expectations to those higher price levels. Okay guys, let's leave it there. Thanks a lot.